Hi guys, welcome back to another video. So the earnings season has finally arrived and I hope that you are as excited as I am in analyzing all the different REITs and the results. So for this video, Mapletree Logistics Trust will be the one to kick off the earnings season. For those who are new to Mapletree Logistics Trust, they are a pure logistic REIT where their assets are diversified into 9 different countries and majority is in mainly Singapore, Hong Kong and Japan. So for Mapletree Logistics Trust, it is considered one of the most stable or safe REIT because of the logistic assets which are always in demand and they are diversified into different categories of different countries. Moreover, they also have a good track record with regards to their management and sponsors, which further makes Mapletree Logistics Trust a more attractive REIT. So let us dive right into their earnings to see how they perform and whether there are any good or red flags to represent. So let us take a look at the key highlights. So as you can see from the slides, the year-on-year values actually looks very green. But if you actually follow closely, the quarter-over-quarter values has not been so flowery with all being in the red instead of green. Moreover, the rental reversion has also went down for the new tenants renewal from positive of 3.5% for the previous quarter to positive of 2.9%. Whereas for the average lease of the tenancy actually dropped by 0.1 years. However, looking at the results in overall, it's actually still a very decent value. Okay, let's take a look at their year-over-year results. So as you know, MLT is a REIT that is one of the most diversified assets in different countries. Therefore, currency actually plays a very big part in their earnings. So looking at their revenue growth, is actually a very good value of 8% year-over-year. Reasons due to additional assets that was purchased compared to last year, whereas the reduction in the growth rate was moderated due to the depreciation of the Japanese yen, Korean won, China RMB and Aussie dollar against SGD. However, they have actually mitigated some of the drop by actually hedging the currency. However, due to recent results, as you can see, the currencies are actually improving against Singapore dollar. So in a way, it might be a good thing for Mapletree Logistics Trust. The impact of the currency weakening from the different countries can never be estimated, as their DPU as actually would have increased by 8.6% year over year if the like-for-like basis was being used from the previous year's currency exchange rate. So imagine it will be additional of 0.189 cents per share. So this actually emphasizes a lot on the impact of the current currency strength against SGD, and this can also be taken note for other REITs that are also dependent on all these foreign assets as well. So for the next slides, everything is the same, but I would like to focus on the provision for doubtful debts. As you can see, they have property expenses have actually decreased from a lower provision for doubtful debts. This can be quite a bullish thing, as this meant that there are lesser number of tenants which might not be able to pay for the payments. So this is a good thing for especially for different other REITs as well. And additionally, borrowing costs actually increased due to higher average interest rate, which is quite common sense. So for the quarter and over quarter of the DPU, it actually dropped by 0.9% from 2.248 cents to 2.227 cents per quarter. So that accounts to be about $22.27 per lot. So with the current environment in the macroeconomics, for MLT is still a decent result with a slight drop in DPU, but their assets are still valuable and will continue to thrive in any environment. So looking at their debts, similar to many REITs, due to rising interest rate and weakening currencies, property valuations have dropped. So for MLT case, it has slightly dropped by 1.87%. It is much better than compared to some office US REIT like Manulife, which dropped a huge value of 10%, because for Maple Logistics Trust, their logistic assets are still very in demand. Thus, the valuation would not be as affected badly as the office US REITs. So for debt wise, similarly, because of weakened currency, they have actually dropped by negative 0.85%. However, when you account for the debt and the property asset valuation, this has resulted in an increase in the leverage ratio by 0.4%. So that's why it's important that REITs have headrooms to account for in the event if due to rising interest rate that cause real estate's valuation to drop. When real estate valuation drops, naturally the leverage ratio will go up. Because for leverage ratio, the formula is taken as the total debt divided by asset. So therefore, if the asset value drops, naturally the leverage percentage will go up. So because of this, it's important for management to balance out and ensure that the leverage ratio do not hit the limit of 50%, which will force the REIT to either come out with cash or sell their assets in order to bring down their debts, which is very undesirable, especially for shareholders. Okay, so looking into their current debt maturity profile, only 4% of the debts are required to be renewed this year. So I would not expect it to affect MLT's current cost of debt as much at 2.6%. So looking at the next slide, they have stated that every 0.25 increase in basis point would cause a decrease of 0.01 cents drop in DPU. So currently their DPU is at 2.227 cents, and at the share price of $1.61, in order to get a yield of 5%, it's only at a DPU of 2.013 cents. However, this value, of course, share price will of course change over time, and as share price increases, the 5% yield definitely will increase as well. Therefore, you can refer to my Excel tracker on the constant update on the share prices and the dividend yield, so to make your decision better. So for occupancy wise, good news is that both China and Singapore have actually done well. As you know, for my previous video, I said that China would be the highlight after lifting of the COVID restriction. I expect both the high-end and middle to low-end assets to do well as stated by the management. Therefore, occupancy should continue to recover healthily over time. Moreover, Japan also accounts for one of the larger assets, also did well by having a higher occupancy of 1%, thus bringing up the overall. So for the lease expiry wise, they have not much of a concern for the full year of 22-23, as mostly have been renewed. As you can see that it actually came down from the last quarter results of 16.3 to 7.5 remaining to renew. So because as logistics is a space always in demand, renewal of these should not be a problem. As you can see from their results for this quarter, their occupancy actually went up, and with lesser amount of lease to renew. So this actually proves again on the superiority in the attractiveness of logistic REITs. So through the brief analysis of Maple Logistics Trust, I hope that it actually brings more light to the results and gives people who are new to the Maple Logistics Trust a better view on whether they should make decision on investing on them or not. So before I end this video, I would like to highlight things about compounding with dividend opportunities during high interest environment. So people argue that REITs are not good to invest during high interest environment because they are running on debts. However, this may not be the case, as there are also good things to take note of during high interest environment, as REITs are valued at better or more attractive valuations for shareholders to buy. If you look at the this table at December of 2022, where share price was around $2 per share, which is about 2,000 for one lot if we assume that every 1,000 shares. So with a DPU at $20.25 per lot every quarter, when you multiply that, you will get $81 for the full year. This was only a yield of 4.05% at this share price of $2,000 at December of 2020. And if you assume that you reinvest the whole dividend, you only get to reinvest 40.5 shares at the share price of $2 each. Whereas now, at a share price of $1.72, with every DPU, you will get every quarter of 22.27 of the current quarter, you will get a much better yield of 5.2%. Although this may not be a attractive or a very good value, but it's still a decent value. When you reinvest the dividend, you'll get at 52.1 shares. So this is much better as compared to the 2020 case, where your dividend DPU will only allow you to get 40.5 shares. So this actually shows how much opportunity is there to buy additional shares. For higher interest rate, yes, there's definitely an argument that there is more attractive, safer assets yield to be purchased, such as the Treasury bill and the country bonds such as SGS bond. However, if you are an investor that would be able to take slight amount of risk, investing in REITs at an attractive yield would be a good time. Moreover, in my opinion, able to reinvest at a higher dividend yield and able to get more dividend reinvested shares would allow you to compound it at a more attractive rate. So all in all, in my opinion, MLT is performing well and adapting to the macro environment well. Although they have a higher leverage and lower interest coverage ratio as compared to other REITs, their assets would or should always be in demand, with management and sponsors having good track records over the years. So with this analysis, I hope that you would be able to make better decisions, and please go and read out more on the rates of interest before making the investment with your hard-earned money. So thank you so much for watching. I'll see you in the next video.